We've looked at the accounting implications of the right of use asset and our lease liability. So let's look at the tax implications. So SARS will actually see this lease agreement as a lease because they look at the legal form of the agreement. We as accountants will look at substance over legal form. So we will actually see this as a purchase transaction in substance. This is now, if I'm not talking about the two recognition exemptions. So therefore, we might have temporary differences that will result in deferred tax, and we will have to make an adjustment to our profit before tax to calculate our current tax. So if we only look at current tax implications, remember I'm not talking about the two recognition exemptions now. Here we have a right of use asset and a lease liability. My total lease payments will usually be deductible for tax purposes if the requirements for deductions are met. For example, it should be incurred in the production of income. There's no distinction made between the capital and the interest portions. There will be no wear and tear, as SARS does not even see it as I'm the owner of an asset. However, we as accountants will have a right of use asset with depreciation that I will have to add back. I've incurred finance costs. SARS know nothing about this, so please add it back. However, SARS will then see your lease expense, the payment that you've made, as a deduction. If we look at deferred tax implications, we now have a right of use asset and a lease liability. So a carrying amount. Carrying amount of right of use asset will be my initial cost minus my depreciation. Lease liability, it will be the balance at the end of the year. For tax purposes, my tax base for asset will be my future tax deductions, but nil will be deductible in future, as SARS did not allow any tax allowances or wear and tear on an asset. They don't even have an asset that exists for tax purposes. For my lease liability, it's a liability, so it's my carrying amount less amounts deductible in future. The full payment will be deductible for tax purposes in future. Therefore, my tax base will be carrying amount less the amount, the total carrying amount will be deductible in future through the payments, and therefore it will be null. Please ignore VAT for third year purposes. So can you see if there's no tax base, but I have a carrying amount, then I will have a temporary difference. Null minus a positive amount will be a amount in brackets, therefore a taxable temporary difference, a deferred tax liability, whereas the lease liability will have a carrying amount in brackets. Null minus a negative amount will be a positive temporary difference, a deductible temporary difference, and that will result in a deferred tax asset. If I look at an example here, an extract, in my current tax calc, I will add back my depreciation, add back my finance cost for the year, and deduct my lease payment that SARS will allow. For my deferred tax, I will have a positive right of use asset amount, a negative lease liability amount, and no or a tax base of null for both of these assets. In the next video, we will look at installment sales agreements.